How's it going, everybody? Better send out the link. So, question today: is the market rational? That is indeed the question. So, one fun example of this is PayPal stock. At one point, the stock was $308, right? Wowza, wowza. Now, today's price, $60. You would think to go from over $300 to $60, something really terrible must have happened to PayPal, right? Well, why don't we take a quick look at PayPal and see what is actually going on here. So, they've had what I think is pretty impressive growth in their business steadily over the last decade or so. Now, they got a really big bump, during COVID, but it's not really that much higher than what their, what some of their previous results were. But it was slowing down before COVID a little bit. And then in 2022, the growth cooled off a bit. But here's the thing. The revenue itself never dropped back to pre-COVID levels, right? It never went from, say, $21.5 billion in 2020 and maybe, $25 billion in 2021 back down to like, $21 billion for the, post-COVID drop, like you see a lot of companies. They continued the growth, it just slowed down a little bit. So if somebody told you, hey, these new highs in revenue that we're achieving back at this time when it was $308 per share, that revenue would stay the same and keep growing, but the growth might slow down a little bit. Would you expect the stock to drop 80%? Because that's pretty much what happened, okay? It is now 20% the price it was in 2021. They would have said, it'll never happen back here. Never. Oh, hey, boys. How's it going in Germany? So, is a slowing of revenue growth into the high single digits from, the upper teens, is that really a reason for a stock to drop 80%? No, unless you acknowledge that it was grossly overvalued back here. That's really what it comes down to. This is a prime example of the fact that the market is really not rational nor efficient. Hence, the exercise of picking individual stocks. I just don't see how it's possible that it's efficiently priced both here and here. Yeah, I mean, it would have been, let's see. No, it would have been 300 plus billion if the shares outstanding are the same. And actually, yeah, they've actually bought back shares. It looks like we're at 1158. It was at 1188, 1187. Yeah, I mean they haven't bought back a ton of shares, so yeah, effectively the same share count. Share count slightly down. So yeah, it would have been in excess, I think, of 300 billion because it dropped 80%. So we're at 1/5 the price. So multiply it by 5, and you would get over 300 billion. I'm usually pretty good at like just snap back of the napkin type calculations, so it's a good shortcut. When I was a kid, I basically never used a calculator. I would force myself to do the actual arithmetic if it was a basic math problem and not just do the shortcut of a calculator. So basic calculations I do pretty well. Well, part of it was, the fancy graphing calculators that were starting to become popular when I was, that age. They were pretty expensive, and I honestly didn't want to ask for one. So, so yeah, PayPal, I think at this point has swung the other way and is probably pretty undervalued, to be honest. Whoopsie. So, one thing to point out, like their free cash flow seems to be pretty consistently a lot higher than their EPS. So I do wonder what's up with that. And the gap got bigger in 2022. Yeah, Monish is really a smart guy, too. So, I mean, I'd much rather listen to him than Stockmo. Let's see. I am curious. So, all right. When it comes to a free cash flow based fair value, if you assume that the last 10 years of average growth is the same in the next 10 years, but this would be a mistake, okay? I think it's gonna be less than it has been the last 10 years. Now I don't know if the current like 8 to 9% is reasonable or not. I just suspect that it's probably somewhat undervalued at the moment. Give them credit for their tangible book value. I don't know. Would we get? Yeah, I mean, if it slowed to 9% and didn't come back up into the double digits over the next 10 years in terms of growth, yeah, I think you could expect a pretty good return from PayPal. Later, John. Hopefully I pronounced that right. But at the same time, like I don't know what numbers people were using in 2021 to justify $300 a share. Because once again, like, let's assume that the 20% growth does last another decade. And we're okay with, heck, a crappy 9% return. And keep in mind, this is going off of current free cash flow, not 2 years ago free cash flow. And free cash flow has grown, right, in the intervening time. So, yeah, free cash flow. Yeah, free cash flow is... Actually, did it grow or did it stay the same? Boop. 2021 free cash flow. Yeah, it's a little less than 2020, but a little bit more than 2021. So, I mean, it was close enough to the same that you would expect. I mean, I just don't see how they were justifying $300. Oh, maybe they thought it would go from down to, I don't know. I don't know. Like 20% over the next 10 years when it's already grown 20%, or sorry, it's actually only grown an average of 17.7%. So we're actually saying it's going to do even better in the next 10 years. Yeah. Like, and at some point it's got to fall. Like, you can't have perpetual 20% growth in a company this size. So I just don't see it. Like, there is no rational basis for it to ever have been $300 a share. I can see it at 65 or 70, and we're below that now. But this is borderline ridiculous. And keep in mind, I've only got a 9% discount rate here, so this is asking for less than an S&P 500 average return. So yeah, okay, discount rate at 3%. Okay, yeah. So if you paid $358 and they grow 20% for the next 10 years, both, you would get a whole 3% return annualized. You can buy treasuries right now and do better than that, And you don't have the risk of them needing to grow 20% to justify it, right? That's how ridiculous that valuation was, in my opinion, of course. But, yeah, I mean, granted, yes, over the long run, you probably will eventually make some kind of return, but that's a really crappy return, Yeah, in 2020, you couldn't... but, if you were going to be okay with, like, a really modest return because money was at zero, why not buy something with a 7 or, 7% yield? I mean, Altria even was like a 7% yield back then, even though their share price was a little bit higher than it is now. Like, if you're okay with just getting like a modest return, buy a stock that, I mean, even Verizon, when they were at like 50 plus a share, their yield was like 4.5% or something. Like, you could just do better investing in one of those, and at least it's a little more stable. Like, those ones didn't fall 80%, Right now, if you had done this because, hey, money's, cheap, I mean, you're down 80% right now, So, yeah, I think, like, something like PayPal, I'm happy making, like, pretty modest assumptions on the growth, and asking for a 12.5% return. Yeah. Okay. So you're kind of. I think you probably had the same mentality as myself. Like buy something that's kind of stable and produces a consistent return because these valuations were inflated by the 0% cheap money and weren't making sense. And you if you buy, that's the thing. People are like, now that stuff has crashed, people are starting to talk about buying defensive companies, right? They're talking about, oh, you got to buy defensive stocks, buy consumer staples, buy Altria, buy Campbell's, buy Coca-Cola. Nobody was saying that when money was at 0% and everything else was so overinflated past past the point of any kind of rationality. But if you had been thinking of buying defensive when everything else was overpriced, say, hey, I think the market as a whole is super overpriced right now, but something like Altria Group is less overpriced than everything else. Therefore, I'll get a better return and won't lose as much in the event of a crash. I mean, yeah, I had my price target for Altria at just pretty much anything 50 or below was where I was adding. And okay, so what, I'm down like 8% on like the share value, but I've collected that same amount in dividends, so I'm actually down zero technically when the rest of the market was down like 20% last year, right? So that's a lot more reasonable in times when you've got the insane bull runs where everybody looks like a genius because stocks only go up, bro, right? So how are you guys in Europe? Like, what is your, I guess, view of the United States debt ceiling, if you guys have heard about it at all? I'm just curious. Yeah. Yeah, I honestly, the day-to-day news doesn't change the way I invest at all. So I don't blame you for not really paying that close of attention to it. But the fact is, people here, I mean, and everywhere, to some extent or another, they worry about things like that. So, show of hands in the chat. Does anybody here ever go on Twitch TV? So, I'm going to give you a little preview of something. So, do you remember the poll I did about Amazon Prime? So, what I'm thinking is at some point I start adding in like a weekly, in addition to what I already do on YouTube, right? But maybe a weekly Twitch live. And then, afterwards upload the previous Twitch streams onto YouTube anyway. But I figure maybe we could start doing something there. Have people do Prime subs since it doesn't cost anything if you've already got Amazon Prime. Another avenue for growth on the channel, maybe. Thinking about that. Haven't done it yet, but doing a little market research first to see if it's worth it. Oh my. Yep. Everybody's got something to say about this, huh? So, any other stocks you guys would like to look at in real time? Any interesting ideas to explore? Another one I like. Um, so, little bit of a brag. I was selling puts basically all through here on Meta. Because they basically, as a business, like they basically print money. And the reason they were down this low, does anybody remember? People didn't like, gosh, it was like people didn't like the legs on Zuckerberg's avatar or something. It was that kind of stupid thing. Oh yeah, and of course, the infinite revenue growth kind of grinded to an abrupt halt. But I never got assigned any shares though. Well, yeah, they say. Well, yeah, they were upset that they were spending so much on Reality Labs, but honestly, it's such a small amount of the money these guys bring in overall. Like, who the hell cares, right? I mean, they were approaching. Um, they were approaching like a 10% free cash flow yield. And I don't know. I just, I think, hey, if that goes well, fantastic. If it doesn't, they can stop throwing money at it, and then their free cash flow goes back to higher levels, and they can switch and pivot to maybe paying a dividend, doing buybacks, etc. Now, what made it start? I know recently some of this giant rise. They announced what, like a $40 billion buyback or something like that. I mean, right now, ad revenue is kind of tough. I've heard that people who actually get YouTube ad monetization have been seeing, like, basically every creator that relies on ad revenue has been seeing a hit because just ad spend overall is down. Everyone thinks there's going to be a recession, yada yada. But we all know recessions are temporary. And once again, it's like you say, don't worry about the news too much. Just pick good businesses that make a lot of money, and you should do pretty well if you pay a reasonable multiple. And I definitely don't agonize over like every dollar of, share price, every percent. That sounds like a technical analysis thing. So, no, I'm not really that familiar, to be honest. Or did you said brands? Okay, sorry, I thought you said bands, like a Bollinger Band or something like that. A small cap tobacco company, huh? Are they? So I assume they're public. So tell me about it. On the surface, it looks like a high multiple, but uh, yeah, I was just gonna see if there was a big disconnect between free cash flow. Yeah, yeah, the free cash flow is quite a bit higher than the EPS this last, and yeah, the normal amount is quite a lot higher. It looks like. Dang, what did they do to bump it up that much in 21? It's disgustingly good. So, what's the case for them to grow, though? Because my understanding is the rate of smoking is going down, at least in wealthy countries. And, British American and Philip Morris International are pretty well situated to dominate in like the emerging stuff in the emerging countries. Like I know Philip Morris International, they were doing a lot in China last I looked, which that's going to be a golden goose for them. Zigzag, rolling papers, chewing tobacco, new gen online presence. So do they sell internationally, US only? Like what's their shtick? Okay. I see. Just looking at their website, yeah, I could see why this would be popular with like millennials. I mean, and I say that as a millennial, by the way. Cigarillos, nice. Vapor Shark. So they're in vaping too, I guess. Okay. So the cannabis lovers blunt wrap. Okay, I gotcha. All right, that's interesting. Yeah, well, and with like you said, the normalized low PE and the potential for growth. Yeah, I can see what you mean. Oh, and they've been increasing their dividend. It looks like slowed it down a little bit recently, but that's kind of understandable. Do you know what happened in 22? Is that the reason why they had a rough 2022? The vaping getting hit by the FDA regulations? Ah, okay. Yeah, I mean the same. I mean, heck, that's why Juul became pretty much worthless to Altria, right? So that's to be expected, I suppose. I see British American Tobacco's vaping product. It's like everywhere. I think it's called Views or something like that. I only start noticing these kind of things like after I get interested in investing in something. I start noticing their products in my everyday life anytime I go somewhere. Sort of like, you know, if you buy like for example, like I have a silver Chevy Cruze. Now I see silver Chevy Cruzes all over the place. It's kind of funny how that works. Yeah, this is one I definitely would look at though. Yeah, like another one that is similar is like 3M. You start like once you actually look at their website and see how many things they make, you then start noticing the little like um, produced by 3M or whatever thing on a bunch of different products. And you'll also be surprised if you look through the catalog of products owned by something like Coca-Cola or Pepsi, etc. They definitely don't just have their flagship, soft drinks. Like Coca-Cola owns like Fairlife dairy products randomly, which I actually really like Fairlife. My grocery store stopped carrying the Fairlife ice cream, and I got really upset because it's actually pretty darn good, and it's like higher protein and slightly lower in like fat and sugar than some of the other ice creams that get sold by the pint. But it still tastes like actual ice cream, unlike a lot of the other like lighter ice creams. So, but then again, I am a Coca Cola fanboy. I don't have any Coca Cola stock, but in spirit, I'm a Coca Cola fanboy. I love basically all of their different products. Well, all of their for soft drinks, all their zero sugar options, we'll say. So Diet Coke, Coke Zero, that's my jam, for sure. You know, honestly, one-time use products can be, they can be a really great source of recurring revenue. You remember those Keurig K pods before people started producing knockoffs. They would sell the Keurig machines just to get you into the ecosystem of having to buy the refill pods to you know, and it's by the cup, right? At home, by the cup. That was clever, but a little bit too easy to knock off. And I don't know about the Vuse products, if they have like a similar setup to Keurig in that sense. Is it like a thing where you buy the Vuse pen or whatever, and then the cartridges are single use? My question would then be, you know, are there knockoff cartridges? So is the actual like pen itself disposable then, or the entire thing gets dumped? Huh. That's crazy. So you have to buy like a whole new e-cig every time you use a Vuse? I obviously don't know much about vaping. I just know that tons of people do it and it's addictive, so. Okay, so there is one with refills. Okay. Yeah, I don't even get why anybody would buy the purely disposable ones then. I would imagine that the disposable ones over time are more expensive, because it can't be that cheap to produce them, and they have to pass that cost on. So you would think it'd be, you know, cheaper for the end user to buy the one that's refillable, because any type of like I don't know, like refill or whatever on it would have to be cheaper than buying a whole disposable unit every time, right? And granted, that's just like rank speculation from me, so take it with a grain of salt. Yeah, I guess there is the laziness factor. You got to cater to that demographic also, right? But yeah, definitely, Turning Point Brands is an interesting one. I'll have to look at them a little bit further at some point. Hey, what was that one? You were doing some research on companies with strong buyback history. There was one you brought up in the Discord. Did you ever end up buying it? Yeah, the one that had the, yeah, it was probably like a 50 million market cap or something like that. I don't usually discuss like very very small market caps on the channel because people, it's easy to get like people trying to accuse you of like pumping or whatever. But gotcha. Did you ever end up buying any shares of that, or where are you at with that? Wasn't it something like some type of coating or something that they do? Or was it some type of like personal protective thing? Yeah. Yeah, I was selling puts the whole time Meta was that low, just because it was so obvious at the time for me that the fundamentals didn't justify that kind of a collapse in share price. I never got assigned though. Not getting assigned there is probably the closest to FOMO I've ever had on anything, because obviously, like, you know, like $8,000 or $9,000 would have turned into like 25K pretty quick, right? But that's the way it rolls sometimes. Like, I got assigned on Baba at what was it, like 84 at one point, and including the premium on the put, that brought my basis to like 79, and I saw it rocket up to 120 or so, and now it's back down in the 80s again. Right, right, right. Yeah, I remember looking at that stuff now. Yeah, I remember they had like these like plastic suits or something that protect you. They look kind of like the ones where, like, if you're going to remove asbestos or something, they protect you from like getting any on you. Sort of, I guess, like, I was almost thinking of them like kind of a mini 3M, because 3M makes like different masks and things like that as well. Yeah, like the hazmat type stuff, like the, or biohazard, rather, I should say. Yeah, I imagine there's probably a lot of really interesting smaller companies that have a lot of potential out there that don't really get a lot of play. The sad thing is, most of the times when someone on YouTube covers like a smaller cap type thing, it's just something they basically chose at random that has low volume that they're hoping to be able to basically drive up short run for like a quick scalp or whatever, basically like a pump. And it's like, I hate to see it. Zero debt's a good thing for sure, especially if on a smaller company like that. makes them a little bit more survivable if times become uncertain. Yeah, and I think the smallest things I discuss are usually in the range market cap wise of like maybe Smith and Wesson, a few hundred million. Now, talk about potential dividend growth. Granted, yeah, they're not always knocking it out of the park. They're pretty cyclical, but they can very easily raise up this dividend, I think. So Smith and Wesson does, or at least I think they have sold to the military. I think they have more police department sales more so than military sales. But yeah, like government, they do government when they can. I'm sure. I don't know what percentage of their business that is, but they have like specifically an M&P series of firearms that are specifically meant, to be like categorized in that military and police area. Although they obviously sell civilian versions as well. Also, when gun sales are slow, they do outsource their manufacturing capacity by they contract out basically their facilities for other companies to use them for basically if some other company has a need for production or machining or whatever, they'll contract out their capacity when it's not being used to manufacture their own stuff. Basically, as like an alternative source of income during times when gun sales are slow. Also, they have a stated purpose of buying back shares. And if you compare them back to 2014, they had. I wonder if this is in millions of shares. So 60 million shares outstanding down to 48 million now. So that's pretty nice. The other thing is they've got a really strong balance sheet. So a lot of cash, although I think most of this was going to their new headquarters because they were changing from Massachusetts to Tennessee or something like that. But the other thing, their inventory, unlike, other types of inventory, like, doesn't really go bad or, necessarily even go out of date. I mean, if a gun was built 5 years ago, it's still just as, like, as long as it's properly stored, there's nothing wrong with it, right? So the inventory, even if the inventory level's a little high, like, it's actually not the end of the world, right? They can sit on it for a while without it being that big of a problem. People aren't necessarily like, oh, yeah, I need the gun that was built in 2022 or 2023 instead of the one that was built in 2019. It's not as important. Oh, yeah, by the way, current debt 0. Long-term debt 37.5 million. Total assets versus total liabilities, completely just, I mean, look at that shareholders' equity, 360 million. That's pretty darn good. Like, the risk of bankruptcy here, like, basically they would have to outlaw guns or something, right? Which is not going to happen. Do they make ammunition? I think they only make firearms. I don't think they make ammunition. I could be wrong, though. Oh, so looks like, I guess they do. Actually, all these are pretty unclear. This comes from an archive from 1976, so that could be out of date. Good old Google giving me something from 1976. Thing is, when I was reading through, like, getting an idea of the business, I don't remember seeing anything about ammo on, like, the actual website for Smith & Wesson. So I know they were doing pistols, revolvers, long guns, and merchandise, but this wasn't this was more like accessories and stuff like that, not really ammunition. Right. Yeah. I mean, the same thing, the same logic applies when I was talking about their inventory, right? Like, yeah, guns don't, like, go bad, right? They just, if they're properly maintained, I mean, people pass their guns down through, like, generations, right? So yeah, that can be a little bit of a concern in terms of, like, I mean, we have more guns than people in this country, right? So, like, there's plenty of guns out there to go around, but the people who are, like, firearm enthusiasts, will want to like keep buying more and more. Sort of like people who buy like collector cars and stuff. People who really really um like these firearms, they just keep buying them. And I mean, they can get damaged, and they can get rust. They can. There's other things. There are things that can happen to a gun to like make it no good anymore, right? But I get your meaning. Like, yeah, it's not as though you buy a gun and then 3 years later it goes bad and wears out. You have to replace it, right? That's not a normal thing. But hey, they've been around since what, like, they're probably the oldest company I actually have stock in. They've been around like longer than Coca-Cola, I think, if I'm remembering correctly. That's not to say, I mean, like, and I also recognize, like, hey, this is not a growth business per se, right? It's a kind of cyclical business, kind of a niche business, caters to a certain crowd. They might score the occasional government contract or something, but this is never going to be, $100 billion company, right? This isn't going to ever be the next Apple or the next Tesla or anything like that. It's going to be what it is, and your return is going to be governed based on things like buybacks, dividends, that kind of thing. They might be able to grow their accessories and stuff a little bit. Um, I mean, at least things like, clothing, footwear, some of this other stuff probably has more of like a turnaround factor to it than an actual gun does. So that might be a good thing that they're growing. Air guns, airsoft guns, paintball guns, accessories. That's a good, again, it's still niche though, right? It's not like they're gonna become $100 billion, airsoft or paintball company, right? But the people who are into that kind of thing are into that kind of thing and will keep coming back to the same brands if they've got loyalty to them, etc. And a lot of the same people that are into like actual Smith & Wesson firearms are into like the airsoft and the paintball and that kind of stuff. So yeah, all in all, like, I think that this is just one of those companies where if you buy it at like a reasonable price, you can get like 11 or 12% a year. Shaped controllers, Meta VR World. Yep. Yeah, get your Smith and get your Smith and Wesson Metaverse controller with a real pistol grip on it. Yeah, that's good stuff, buddy. All right. Well, hey, I've been at this an hour. I got a few things I want to do today. It's been really awesome talking with you. Hopefully, I'll be able to do this again next Sunday. Hopefully, you can join again, man. It was pretty fun. And hopefully, the any other observers got something out of it too. Take it easy, man. And it's Monday for you almost, isn't it? Have a good week, all right? Peace.